All right, so on to our next question. Our next top question is really how do we determine our company's valuation? Especially because for startups, you're in such early days of building that it's really difficult to attach a specific number onto your valuation. I think it's a super valid question. One of the first things to figure out is your detailed circumstances. For example, what product is your startup building? Are you software? Are you hardware? If you are software, are you selling some type of actual built-out software, or are you selling some combination of software as a service where there's a service component embedded, or are you selling some type of data that is some type of unique insight that you've derived from some sort of database that is put together in the wrapper of a software? And then if you're hardware, what kind of hardware are you? Then we start to ask questions like what industry specifically are you in? If you are in healthcare, you'll have a very different outlook depending on, for example, your FDA approvals process for your valuation, as opposed to if you were building a pure software as a service company. So in determining your startup's valuation, of course, it's based on all of these different caveats. But if I were to just give some blanket overall insights as to how to think about your valuation, here are some broad rules of thumb. So this is mostly applicable to startups that are fundraising here in Silicon Valley. You're building something that is tech enabled, where you're really leveraging some sort of technology to do something better, faster, cheaper, more efficiently. And you are thinking about fundraising from VCs and or even earlier angels. So if you don't fall into any of these buckets, these rules of thumb don't necessarily apply to you. So typically in Silicon Valley, the way that we look at valuation is that in those super early days, when you don't have much data to prove where you are, oftentimes that valuation number can be more art than science. So oftentimes we're looking at a super early stage startup. If you just have a founder and an initial idea, but you really haven't built out much of the idea, or you have an early prototype of the idea, but no substantial numbers in terms of traction, like customers, users, retention, cost of customer acquisition, or even things like what specifically your company cohort by cohort looks like in terms of retaining users, et cetera. That means you're super early. And when you're super early, it tends to be in the single digit in millions when you're fundraising. So this depends on your specific industry and sector. If you have a super large TAM, TAM, which stands for total addressable market, then you can grow really effectively into that specific space you're building in, and you have a larger total addressable market. Oftentimes you can justify a slightly higher valuation. But again, in those super early days, you're really looking at single digit millions in terms of valuation, because people are funding you just based off of belief and conviction in your specific team. Now, if we're talking about now, you not only have the team, but the team has gotten together and really started to build out a little bit more product. You've gotten a little bit more traction. You can have some revenue or user numbers to showcase. That's where we're starting to look at a slightly higher valuation, where you're in the high single digits to possibly the low teens, if you're able to start to demonstrate some real revenue numbers. So if you're able to showcase some type of monthly recurring revenue, incredibly helpful. By the way, keep in mind that recurring revenue is the key. One-time revenue is great, but if you can demonstrate some sort of repeatable need for your product, and so that this is not a one-time number, but that it will continue to scale, that will definitely help improve your valuation numbers. And then also, on top of that, if you can also showcase that your revenue is not concentrated in one specific customer. So it's not one person who's paying you 95% of your revenue base. That's also incredibly helpful to be able to showcase, to show that, hey, I'm actually demonstrating that there is market demand for my product or service because I've been able to get all of this organic customer and revenue data, not just from one specific buyer, but this profile of buyers that I can replicate and scale and grow into. That's also helpful for valuation. So the higher the revenue number that you can showcase, the higher the user number you can showcase, the higher the likely valuation. But typically, if you're in the hundreds of thousands, well, if you're in the tens of thousands of monthly recurring revenue or even kind of annual recurring revenue, you're really looking at the kind of high single digits, low teens. When you're starting to really get into hundreds of thousands in monthly recurring revenue, which then scales up to you're looking at, above a million in annual recurring revenue, this is where your company valuation is starting to become more substantial, where you're starting to look at low to mid teens in terms of your company valuation. And then, of course, any sort of background that you can articulate from the founders, if you had prior success, for example, you previously built startups in this space, you previously built product in this space, it all helps you fundraise. But of course, if in the past you've been a unicorn founder, or you've had some really incredible success with a company that you took public, this is where even if you don't have a lot of revenue numbers to showcase, your starting valuation is probably in the double-digit millions, as in you're talking about anywhere between 20 to possibly even $50 million in valuation in those super early days with very little numbers to justify. So we are at a point in time in the markets where it seems like these valuation numbers are all over the place. And if you're building in a space that investors are paying a lot of attention to, where there's a lot of demand, especially with anything relating to AI, because of how popular AI is as a topic this year, feels like you can justify really high valuation numbers. But just keep in mind that typically those valuation numbers are justified by either the founder's background, prior successes, track record. Basically, they're all the same thing. Or it's justified by the number of customers that you have and the retention that you can showcase, the growth curve, the growth rate you can showcase. Or it's backed up by your revenue numbers. And again, the scalability and ability for you to continue to make that recurring revenue. So there's usually some foundation. So hopefully this leaves you with some helpful benchmarks. So if you're just starting out, there's not much. Looking at low single-digit million in valuation. As you start to get more revenue, more customers, you're starting to look at higher single-digit millions in revenue. As you scale up the number of users that you have, you're looking at hundreds of thousands of users in your use case, where you're looking at hundreds of thousands of revenue on an annual basis, you're really looking at kind of low to mid-teens. And then, of course, when you're getting close to the million in annual recurring revenue, and you're really scaling up from a revenue and users perspective, and if your user number starts to hit millions, you're looking at high teens and possibly even kind of above 20 million. And once you go into the above 20 million space, this is where it really could land anywhere depending on your specific numbers. Because if you could all of a sudden cite you have 10 million users, that's very different than if you had 1 million. But hopefully this helps answer the how do you determine your company's valuation from those very, very early days, because it directly impacts the amount of equity that you give up. And also, the last note I would want to end on setting valuation is oftentimes founders think that, of course, the higher my valuation, the better, right? Not absolutely. Everything always comes with pros and cons. So the higher valued you are, it also means that you're setting investors' expectations really high. So imagine an investor's perspective. They're saying, I'm willing to give you this amount of money with the expectation that it will 3x, 5x, 10x, 50x. So the higher your valuation is, the harder it is for that to 10 times itself by the next round that you're fundraising. It means that you have to have 10 times more traction, more growth numbers, more customers, more revenue in order to justify being able to fundraise the next round if you don't want to raise a down round. And down rounds are incredibly hard to raise because you have to apologize to prior investors around why your company is worth less. And you have to somehow convince new investors that there's something really new happening at your company that you're able to raise better. So all in all, try to strategically position your startup now at the right amount of valuation where, let's say if you're fundraising 3 years later, that you comfortably can hit what that valuation, that next valuation number might look like. Just as a general rule of thumb between seed, well, pre-seed and seed to Series A, typically investors are looking for at least 3 to 5 times in returns. So if they were backing a company, say at $15 million, they're really looking for this company to be worth at least 3 to 5 times more by the time they raise that immediate next round. So if you're thinking about that number, well, what would I need to do in order for my company to be at least performing 3 to 5 times more? And of course, investors are always on the hunt for companies that are really returning 10x or more. So when you're in your early stages, you have to demonstrate that growth potential. So how do I think about what I need to have? So I currently have, let's say, 10,000 users and I'm starting to fundraise in the very low teens, then I really need to think about how do I hit hundreds of thousands of users within the next 2, 3 years in terms of do I have enough capital in order to build the product to scale it up to get there? So when you're thinking about fundraising, it seems like all of these questions are somewhat interconnected. It's not just how do I determine the valuation, it's also how much should I be raising now so that I can get to the next round successfully. Hopefully that helps give you a different perspective into how investors think about this question.